All right, why don't we get started? So thank you guys for joining. So we're going to talk about reporting season, which kicks off at the beginning of August, but is going to obviously ramp up as we get a little later in August. And the goal for today is to talk a little bit about the macro environment that we're walking into earnings season with, or reporting season with. And we'll get started in 1 second. So first of all, anything you hear today is general advice. I obviously don't know anything about you. I can't offer personal advice, but questions are great. So if you have any questions, comments, anything else, pop them into the chat or the Q&A, and we'll get to them as we go along. And Daniel's saying, first of all, he said hi, which is very nice. He thinks there's going to be a retail recession. I think we're in one already. So we will talk about that, among other things. But before we get started, one really important thing to remember is the way that the share market works is, of course, it is forward-looking, and the expectations of investors in aggregate are baked into security prices. So what does that mean? It means that we don't want to look at news just simply at the news, and whether it's a good or bad thing, we need to look at it in comparison to the expectations that people have. So that is why sometimes news that sounds bad, the market actually does quite well after that because people expected it to be worse, and vice versa. People expect things to be going very well, and even if they seem like on surface basis they're going well, that can disappoint investors. So we just need to realize that as we go through. So I'm not going to say anything that probably is remarkably new to anyone, but it's just kind of setting this macro environment that we're walking into earnings season on. And of course, as investors, even though companies are reporting things that have happened in the past, we use that as clues into what's happening in the future. So obviously, we know things that are going on with interest rates and inflation. We know that that's going to impact consumers and ultimately companies, but really what we're looking for are clues as clues into what that impact will be. And then, of course, what that impact will be going forward for earnings that we get in the future. So just to give a little bit of an overview, we want to look and see where things stand. So what we're looking at here is the Australian market. We're looking at the different sectors that are in the Australian market. And we're looking at how things have done in the past year. And then we're looking at the Morningstar price to fair value ratio. So what that is it's all the shares that we cover within those individual sectors in the Australian market. And it's looking at how they are trading in aggregate versus our aggregate fair value. So anything above 1, we believe is overvalued. So for instance, if we look at consumer discretionary right here at 1.05, that means we believe that in aggregate, those shares are 5% overvalued. Now, as we move on in this monthly earnings season webinars, we'll start talking about some specific shares and where we see opportunities. And of course, as we start seeing those results coming in. So as you can see, overall, the market has performed reasonably well this year in Australia. And you can see that from a price to fair value perspective, and if we look at the overall market, we think it's about fairly valued. So what you can see is those different sectors that we believe are overvalued and undervalued. A couple things that we should note is that, of course, all of these sectors are not equal in terms of their representation within the ASX 200, because we're looking at, no matter what we look at, but generally we're looking at a market cap weighted index. So bigger companies will have more of an influence. And particularly when we're looking at a smaller market like Australia, it's hard to make generalizations about sector performance because they can be heavily impacted by individual companies. And a good example of this is healthcare. So you can see overall, healthcare has actually performed worse than any of the other sectors in the Australian market, but largely that is because of CSL. And CSL is a very large company in the overall index, and it of course dominates that healthcare sector within the Australian market, and it has not done well in the past year. So anyone who owns CSL, of course, probably already knows that. And that is, of course, dragging down those overall returns. So that is something just to keep in mind as we look through here. So hopefully there's nothing on here that really jumps out. So I think we've, of course, seen that that we've had a tech rally, so even though it's a small portion of the Australian market, that is the best performing sector. Energy continues to benefit from really strong pricing with a lot of those commodities, whether it's oil, gas, coal, etc. And you can see, even though energy has performed well, we still see it as the cheapest sector that's out there. And part of this, of course, is investors positioning their portfolio for how they see the economy going. And a lot of people are worried about consumers. And you can see that these consumer staple shares, so those, of course, are companies that make things that we should buy, whether the economy is doing well or poorly, areas where consumers can't really cut back on spending. We can see that that's our most overvalued sector. So just something important to remember. All right, so let's go through some different areas. So let's start with the consumer. So of course, in a macro sense, what we're looking at here is, of course, the impacts of inflation and higher interest rates. And both of these take some time to work their way through the economy. So even though we are at a stage where we're starting to see some positive impacts from inflation, it can, of course, continue to impact consumer spending, even as that inflation rate comes down. And I think most people on here probably get this, but I didn't see this comment. Just because inflation comes down, as in the growth of inflation, the growth of or the increases in the cost of things that we buy on a daily basis, doesn't mean they're getting cheaper. So someone comment like, "Oh, good, like prices are falling," and well, they're not falling; they're growing at a lower rate. So something important to remember, and we do need to remember about inflation, is that it does take a while for it to impact consumer behavior. And I think we're really starting to see that right now. And basically because initially, sometimes people don't notice. And when things start ticking up in price, maybe people don't notice till they start looking at the end of the month and how much money they've spent. So it does take a while to change behavior. And of course, interest rates, the same thing. So we hear about mortgages all the time in Australia. Of course, and we hear about the mortgage cliff, but it does take some time, of course, for those interest rate increases to work their way through the economy. So something important to remember. But if we look at the consumer in general, who's being impacted by both, right? Inflation, when things are cost more to go out there and buy, and then of course are getting the impact of higher interest rates, especially as some of these fixed terms and mortgages are resetting. We can see it's really starting to have an impact on the consumer spending. Now, once again, this is nothing that people do not know. This is, of course, widely known, but we can see that household savings to income, so people are saving less money, obviously responding to those higher prices, those higher mortgage payments. So lowest point in 15 years. And then we can see as a percentage of aggregate income that people are making, mortgage servicing costs are continuing to creep up. So the highest level in terms of percentage of income since 2008. And one way that we can get data that's, I guess, a little more recent is by, of course, looking at spending on credit and debit cards and everything else. And so ANZ came out with this chart recently, and we can see across almost every category, except for, of course, groceries. So groceries, of course, would be considered a consumer staple. We do have to eat, as Phil just said. We see that spending pretty level. But then, of course, we see some of this discretionary spending, shopping, going out to dinner, getting takeaway, and of course, travel. We see it starting to fall. So this huge surge we had as people emerge from COVID, we do see a big drop in that spending. And of course, that's going to work its way through the earnings of a lot of companies. And we have seen some downgrades already, and we have seen some companies kind of pre-report, especially in that consumer discretionary category around issues that they are seeing with drops in spending. So once again, this probably shouldn't be anything that jumps out on anyone that's been following the news or the economy at all, but we can see spending start to drop. So of course, during results season, we're going to start to see which are the companies that are impacted the most by this, and then of course how large that impact is. So pretty low expectations around consumer spending, pretty low expectations going forward as we continue to see, especially interest rates work their way through the economy, but something that a lot of people will be looking at how big this impact actually is. And then, of course, we need to look at corporations. So inflation works both ways. So number one, inflation, of course, works in terms of changing consumer spending patterns. And we want to see how that goes and how that's going to impact companies. But of course, it's influencing, of course, how much it costs for companies to produce goods and services. And what you can see here is we are looking at wages, and we are starting to see wages climb. And of course, this makes sense that we do still have a really tight economy in terms of the unemployment rate is still really low. Companies obviously need workers. Those workers are being pressured by increases in the cost of living and are demanding higher wages. And so we recently saw, just one example of this, how the minimum wage was increased. It was announced obviously a while ago, but did increase in June. But we can see we're starting to see a lot of growth in wages. And you can see this, obviously we had this long period of pretty low wage growth on an annual basis. It's starting to go up pretty steeply. And we do see central banks, of course, talking about this a lot. And, this has been a term that's been out there for, the past year or so, and obviously not a new concept being talked about more, is, of course, this sort of wage spike feeding into inflation. Right. So obviously, as companies have to pay workers more, they're going to start to raise prices. Workers are going to demand more money. And it is something that a lot of central bankers are talking about. And it is certainly a fear that this will continue to drive inflation at levels that are higher than central banks want it to be. And that will either require further interest rate increases or just not lowering them anytime soon. So something to look out for. There is an interesting article in the AFR talking about sort of the difference between the stock market and the bond market right now, and how the bond market is signaling that there is going to be continued high interest rates, that they're not going to come down as some of the more optimistic people believe. But certainly something to look out for, those wage price increases. And as companies report, we should start to see this. And I'll talk about margins a little bit, but you should obviously see more of a focus on cost and what are the costs the cost to produce those goods and services that they come up with. The other influence that, of course, we see around higher interest rates is debt. Now, debt's something that I've been talking a little bit about for the past 6 months or so. So globally, when we look at debt, whether that's consumer debt, whether that's corporate debt, whether that's government debt, we do collectively as a world have very high debt. Right now, we're just kind of looking at corporate debt because, of course, we're talking about earnings season, and this will be something that you'll see as well. So the companies will have higher costs to, of course, maintain that debt, and they'll have those higher costs. And once again, it takes a while for them to potentially impact companies because some of that debt, or a lot of that debt, is likely fixed rate, which means you've locked in a lower interest rate until, of course, that debt matures and you have to replace it with new debt. And it doesn't all mature at once. So you'll see kind of this creeping through as long as interest rates are higher. So we can see if we look globally at net debt, we can see it has come down a little bit, which is certainly a positive thing, but significantly higher than it has been if we go back and look around 10 years ago. Good news is in Australia, and this is a small chart, but Australian companies have very low levels of debt, which is a good thing in this environment, and certainly a good thing from a risk perspective. So you can see Australia is the second line on here, and you can see that corporate debt in Australia has actually fallen pretty meaningfully in basically a little less than 10 years, right? So we see it going from 79 down to 48, which is good. And we're starting to see companies obviously shore up their balance sheet. That's a 22% drop. And then in a constant currency, which is just what Janice is using, Janice Henderson, who created this. You can see the drops a little less because of fluctuations in currency, but provided it's Aussie dollar debt, that's really what we want to look at, is that aggregate change. And that's a very good thing, right? Debt is always a problem. It's always a risk for companies. The less debt you have, and it can be a good thing as well, but the less debt you have, the less risk a company has. So you can see Australia is in relatively good shape compared to the rest of the world. And we've seen particularly the miners paying off a lot of debt that they have. So I think I read somewhere that the miners are actually net cash positive for the first time in a very long time. So that's certainly a positive thing. So what's happening in the UAE? I guess they're pumping a lot of oil and and in pretty good shape. But yeah, I actually do not know what's happening in the UAE specifically, but good question. All right, so let's look at net profit margin. So as I said, as of course you are paying more for goods and services, producing goods and services, as consumers are spending less and perhaps that consumer spending is shifting in response to inflation, one thing that we're of course worried about is the margin. So the net profit margin is how much a company is making versus how much they sell. So how much do they get to keep in earnings versus how much they sell? What's that top line revenue and that bottom line earnings? So what we can see here is that while margins are still high, now this is the S&P 500, just because that's where I could find data on this, but since conditions are similar in Australia, it's something we really want to look out for in earnings season is we want to look at that margin. So what we're of course looking for is companies that have the pricing power to raise prices more than the cost of their inputs, the cost of producing those goods and services and servicing their debt goes up. That's really what we're looking for. Companies that do have pricing power. But you can see in the US for 7 straight quarters, the net margin has gone down. Now, still historically, we're at a pretty high level. And this obviously only goes back for 5 years. But even if we look back before that, we're still historically at a really good level. The question will be, will this continue? And of course, we do not like to see margin drop as investors because, of course, as the owners of companies, we get to keep what comes out the other side, which can either be reinvested in the business, paid out dividends, buybacks, etc. So it is a number that we'll continue to look at. So I think as earnings start to come out and as companies report results, you're going to see a lot about margin. See who is doing a good job of passing on these costs. So whether it's those wage costs we talked about, or just the raw materials that go into any company that's manufacturing things as well. And then interestingly enough, if we start looking at sectors, we can see the relative winners in this environment from a net margin perspective and the relative losers. So basically we're looking at 2 different bars here. We're looking at Q1 2023, and once again, these are US numbers, but we see the same impacts in Australia. Q1 2023 versus a 5-year average. And 2 things in particular stand out: financials, which has increased their margin, and energy. So we can spend a second talking about this. So first of all, from a financials perspective, banks, which obviously make up a lot of financials, but also things like insurance companies as well, asset managers, but they tend to do pretty decently when we start moving into a period where interest rates are going up. it tends to increase that spread that they are earning on lending. So we obviously read about in the papers all the time how immediately when the RBA increases rates, all the banks pass that on immediately to all of their, of course, mortgage holders are a large one, and increase rates. And then slowly they work their way through some of the term deposits and the other interest-bearing accounts that they have out there. And so generally what we see is we do see financials doing well. Now, when financials do not do well, even in a rising interest rate environment, is when it starts impacting the economy. And of course, loans start to not get paid back. So of course, that impacts profitability. But so far, we haven't really seen that. So you can see financials increasing. Energy is a pretty obvious one, with a really big increase in margin. And of course, that's because of higher prices. So at the end of the day, during this 5-year average, we saw the price of a lot of commodities like oil, gas, coal, et cetera, plummet during COVID. And that, of course, impacted the margin of a lot of these energy companies. And there's a lot of fixed costs involved in these companies, right? You operate a mine, you operate an oil field, a lot of fixed costs, a lot of heavy spending to build out that production. And of course, you get basically an immediate hit to the bottom line because it doesn't impact how much it costs to produce a barrel of oil. But when oil prices go up, of course, you're getting more money for it. So we can see really strong increases in energy. So some of the sectors that have done well from a net margin perspective. So we have a couple of questions in here. So we'll pause for a second for questions. Let's see. So does the 1-year return include dividends? That is a good question. I believe it does, but I do need to double check that. So thank you for that, David. Fitch's US credit downgrade was interesting. Yeah, so people don't realize one of the rating agencies, Fitch, lowered the US government debt from AAA rating. Now, it seems like so far the market has kind of shrugged it off. The other rating agencies came out and reaffirmed their ratings, but we will see. So it certainly would be interesting if you started to see more downgrades of US debt, especially because the US government is in so much debt. So yeah, it will be interesting. That could increase borrowing costs and of course have a pretty significant impacts. Okay, so Paul says, I think the energy sector ought to have a clear delineation between fossil and sustainable based energy. Yeah, no, I mean, I think it would be interesting to look at that. And we've got a comment that the transition away from fossil fuels will likely be inflationary. Yes, that's very likely. So of course, anytime there is a huge increase in spending, and there's obviously going to be a huge increase in spending during the whole energy transition, that is, of course, inflationary. So it is something that a lot of people are citing why inflation will continue to be higher than it has been in the past. It's all this spending around the energy transition. So yeah, that's a good comment. Okay, so Michael says interesting numbers, but are they nominal numbers or real numbers? So of course, we're looking at, are we taking inflation into account? If they're nominal, then the story doesn't look so good. So I guess, sorry, just Michael, I don't know which exact numbers you're looking at. So when we're looking at net profit margin, it doesn't matter, right? Because we're taking inflation into account on both the hopefully higher prices of the goods and services companies are selling, and then of course the higher input. So I don't know if you're referring to these latest margin numbers, but yeah. Anyway, if you could clarify that, I'll be happy to comment on it. All right, so let's look at valuation levels, because valuation levels are of course, interesting. So we're starting out with the Australian markets. I got these from Barclays. And what we're looking at here is, which I realize I did not label, what we're looking at here is the CAPE ratio. So I like looking at the CAPE ratio. I'll explain what it is in a second. So we're looking at the CAPE ratio. So the CAPE ratio, oh, here it is. It says it right there. So what CAPE stands for is cyclically adjusted price to earnings ratio. And what that basically means is that we want to go back and look at a longer period of time and average out those earnings. The reason we want to do that is because we want to remove the cyclicality that is inherent in markets all the time. And so basically by averaging out over the past 10 years, we're smoothing out those natural falls and rises in earnings. Because if you just look at a PE ratio and you don't adjust it, you're just looking at that PE ratio, we can see spikes and troughs, right? So obviously, as the economy does well, you are going to hopefully see companies earn more money. And that, of course, can change those earnings levels pretty substantially. And then if the economy doesn't do well, they could fall a lot. So what we're doing is we're smoothing out those numbers. And really, anytime we're looking at a relative valuation number, the number doesn't matter, right? There is no good PE and bad PE because there's all sorts of assumptions baked in there around growth and everything else. But what it does allow us to do when we use those measures like a CAPE ratio is allows us to go back and historically look at if the market is historically cheap or historically expensive. So sitting here and looking at Australia, what we can see is certainly the market does not appear to be cheap in any way. It also does not appear to be expensive. So we're kind of floating in the middle from a valuation perspective. And it is just about average. And we see the same thing on this next chart of the US. Now, obviously, and I'll talk about this in a second, the CAPE ratio, the overall CAPE ratio, you can see is higher, right? So we're above 30. And then in Australia, we're just above 20. And we'll talk about that difference. But also, once again, market does not certainly seem historically expensive. We go back and look back until 1980. So kind of sitting around average. At this point. So it is important to remember that it certainly is not a cheap market. It's not a shockingly expensive market like the run-up we had after COVID. And of course, here is the dot-com bubble right there. So yeah, market's kind of floating in the middle a bit. So there certainly isn't, from a valuation perspective, I'd say a huge cause for concern, but also a huge signal that things are actually cheap when we look at the CAPE ratio. Now, one thing to know, if you compare these two markets, the Australian market to the US market, you'd of course say the US market is more expensive, which it is. And as investors, we of course need to make a judgment whether that whether the US market being more expensive is justified or not. And really what we're looking at here when we're looking at something, any of these relative valuation measures like the CAPE ratio, is we of course need to incorporate growth into that. Because as investors, when we look at these backward looking ratios, so price to earnings ratio is a backward looking ratio, the CAPE ratio is a backward looking ratio. What's really important is to remember is as investors, we are buying the future. So what matters is what happens in the future. If we expect really good things in the future, we expect continued growth, really high earnings growth, then we would pay more. So that is something that's important to take into account. Now, it's up to us to say, do we think this is justified, the difference between Australia and the US? And I think some people would argue it is justified. There are different types of companies that make up the index in the US. They tend to be higher margin, higher growth companies, a lot in the tech sector, whereas Australia, we do not see that. But obviously the question is not on an absolute basis, is the US more or at a higher valuation or not, but is that actually justified? And that's how we can make decisions going forward. So something to consider there. All right, so let's talk about some expectations. So nothing I said and nothing I showed you, maybe it's new to you, but certainly is widely known by most investors. It's widely known that obviously inflation and interest rates are working their way through the economy. It's widely known that shares are not cheap. It is widely known that consumers are suffering and consumer spending is dropping globally and here in Australia. And of course, that debt is a problem and it's going to eat up more of earnings. But look at a couple different indications of sort of where expectations are walking into earnings season. So as you can see here, analysts, of course, expect earnings per share, so the earnings generated by companies, to fall. It's important to have that expectation. If we surprise on the upside, that could be good for the market. If it falls more than expected, if earnings fall more than expected, then that, of course, would not be a good thing. And in this current half year, which we just started, of course, we're getting reports on the previous half year, the expectation is that earnings are going to continue to fall, but that they'll reach a low and then start to recover. So that's also really important to think about as well. So as I said in the beginning, is that the market in general, at least the stock market, is getting more and more optimistic that central banks can actually land this thing, as in they can cut inflation to the point where it's within their range and within their goal and not force the economy into a recession. So there has been a lot of talk about recession. People are getting more and more confident. Investors are getting more and more confident that maybe we can have the soft landing that people have spoken to. The question, of course, is what will happen. So at least as investors, we know that the expectation of a lot of people is that we will have a soft landing, that we will not fall into recession and get inflation under control. Now, if that does not happen, if either the economy starts to do really poorly and falls into a recession, or inflation is not actually brought under control, and there's some good signs, but still a little too early to declare victory, then of course that could be very bad for the market. So something to think about. If we look at Australia, a lot of where these losses, of course, Australia is dominated by banks, dominated by miners in terms of the market, is there is expected to be a big fall in income for the resources sector. Now, a lot of this is kind of predictable at the end of the day, because we actually know what commodity prices were during the 6 months that we're about to get, for many companies, we're about to get earnings reported in. So we do know what those expenses are, or do know what those prices were for commodities that are being sold. So you can see right here, resources sector, the expectation, of course, is that we're going to have a big fall in earnings. So this is not a reason to go out there and sell the resource shares, because once again, it depends whether those expectations are met or not. If we see further drops in earnings, then of course that'll be bad. And we're once again trying to get this expectations thing baked into everybody's head. So yeah, dropping 17.8% is not good. But even if earnings drop 15%, that's not a great thing just on its own, but compared to expectations, you could see a rally. So something important to look at. And then dividends, of course, everybody loves dividends. Now, we've had a lot of volatility in dividends. So, of course, during 2020, we saw a big drop in dividends as companies delayed them, cut them, suspended them. We've seen them bounce back, but we also have to remember is that we did see some very high one-time dividends, particularly out of some of the resource companies that did very well. And we do in Citi, and we'll talk about Morningstar's view on individual shares next week, but Citi thinks dividends will drop 6.1% in the 2023 financial year and will continue to drop. But a lot of this is driven by two industries, so banking and resources. So because they make up such a big part of the Australian market, they're obviously going to drive what the overall Australian market does. But on a positive note, if we eliminate those two, resources and banking, Citi does see dividends growing. Now, traditionally, people have, of course, gone to the banks or purchased the banks and resource companies to get some of these dividends. So that's why it's really important that we think about the overall market composition and the composition of our portfolios. So we take a market cap weighted index that allocates a lot to banking and mining. Could be a very different story than if we look at an equal weighted index that puts equal amount of money into every share within that. If we say ASX 200, equal amount of money into those 200 shares. So yeah, interesting difference between those overall numbers and then kind of where Citi sees dividends going for the rest of the market. Okay, so we got a couple questions that we can. So Lisa's asking, is lower CAPE ratio better? Yes. So think of CAPE ratio, it's the same as a price to earnings ratio. So lower means cheaper. So if we have a CAPE ratio of 10, that means that the market's trading at 10 times the cyclically adjusted price to earnings ratio, basically that average earnings over the last 10 years. So all things being equal, would you rather have the market be cheaper? That's better than trading at 20 times. So yes, thank you for that. All right, let's see. Oh, we've got a couple of long ones. So James says, have you used the Buffett ratio? So GDP to total corporate profits to determine market value. I have not looked at it in here, but yeah, it's another way that sort of Buffett is trying to look at the overall market and smooth out some of those sort of spikes and troughs that we see. But I have not looked at that, but that's actually an interesting one. So Paul says US versus AU CAPE looks interesting. The US has risen beyond 2007-8, Australia trade bound. Yeah, so I mean, I think it's a good observation. Really, what we've seen, if we go back and we look at the performance of the Australian market, remember there's two things that are going to change the CAPE ratio. One is, of course, the performance of the market. So that's the price side of things. And then, of course, how those price increases increase, or how those compare to increases in earnings. So what I will say is we go back to the GFC time period, 2007, 2008, the US market has done much better than the Australian market. Like significantly better than the Australian market. Now, a lot of that is because it's gotten more expensive. Now, people would say it's because of technology, these giant companies that are driving the US market, and that's fine. But the US market has gotten a lot more expensive since the GFC, and mostly because, of course, the price appreciation of the market has outpaced earnings growth in the US. So that's, primarily due to a lot of these technology companies and how their valuation levels have kept growing and growing and growing. Even as they've grown earnings, those valuation levels have grown more. But that's an interesting observation, Paul. Let's see, what else do we have? Have the shockwaves in the US banking system washed through or more to go? Okay, so interesting question. So just kind of taking this back, we of course had a spate of US banks collapsing. So kind of the most famous one was Silicon Valley Bank. And really, what happened at the end of the day is that a lot of banks were trying to earn extra money in the capital that they hold, right? So of course, banks need to hold capital and they invest that capital. And what Silicon Valley Bank did is they invested a lot of that into longer term bonds. And the problem in a rising interest rate environment is, of course, bond values fall as interest rates go up. Just kind of mathematically, that's how things work. Now, if you own that bond, really what's happening is, we can call it a paper loss. If you own a bond and you are paid back, so if I go out and buy a US government bond and the US government does not default, as long as they pay me back, really those are just fluctuations in value over the course of that time period, right? And it doesn't really matter as long as I hold that bond to maturity. I know what interest rate I'm getting because that's the interest rate when I bought it, and I'll get my money back at the end. Now, what's happened with Silicon Valley Bank, and the problem with banks, of course, is they have to maintain a certain amount of capital. So as you mark those bonds down, the bank needs to hold more capital. And what happened is there was a bit of a run on the bank, there was a run on the bank, and people were pulling deposits out of the bank. And it became more and more difficult for them to satisfy those deposits because they didn't want to sell any of the bonds in their portfolio because of this sort of obscure accounting law. It's not obscure accounting law, because of accounting treatment of these bonds, where you don't have to recognize those losses as long as you say that you're holding those bonds to maturity, which I'm sure the bank was planning on doing. The problem was they got in a situation where they were running out of money to give back to depositors. They didn't want to sell any of these bonds because if they sold the bonds, all of a sudden the market would start saying, hey, these assets that you're holding are not worth as much. And they ran into a problem and, of course, went under. I don't know is the answer to David's question about kind of shockwaves in the US banking system. What I would say is that dramatic changes in interest rates have a lot of knock-on effects on all sorts of different things in the market. And so I don't expect those are over yet. So it can sometimes take a while to actually have these knock-on effects be recognized and have and see that impact. So I would say probably not. And especially around, I talked about how Australia is in pretty good shape. A lot of companies have taken on a lot of debt. Rising interest rates, of course, have impacts on that. And that impact may be kicked down the road. It may not come until these companies actually have to go out there and that debt matures and they have to roll it over. We may not see it until then, but my guess is no. And kind of one thing that we've been talking a lot about in Australia around particularly sort of real estate, if we're talking about kind of commercial real estate, is one of the problems is the impact that changing levels of interest rates have on the valuation of things like commercial property. And so we've seen this a little bit in Australia, where a lot of sales of buildings, particularly sort of office towers and CBDs, a lot of things have been put on sale and then pulled off the market. And some people suspect that's because nobody wants to mark those to market. As soon as you sell a building, right, you can have a model that says this building that we're sitting in is worth whatever, I don't know how much a building is worth a certain amount of money. And your model is going to react much slower than real life. But as soon as you go out and sell something, then you're setting a new price. And so we have seen people pull buildings off the market. We have seen a lot of talk around super funds, particularly industry super funds. Are they appropriately marking these infrastructure and real estate assets that they hold, that they put a lot of money into? Are they valuing those appropriately? So I think there's probably more to come with that. And with super funds, it's always an interesting one, because the issue is that if you are not valuing those parts of your portfolio correctly, you're really stealing money from one group of super fund investors and giving it to another, right? So if I'm redeeming right now, and if you're Australian Super that puts a lot of money into infrastructure, commercial property, private equity, all this stuff that's hard to value because it doesn't trade on a daily basis, and I am not valuing that correctly, somebody who is pulling their money out of those super funds, it's great for them because they benefit from those higher valuations. But if you're putting money in and you're going to see those values drop in the future, well, that's not good for you. you're basically buying at too high of a level. So there's been a lot of talk around that. So I think that's something that we might have to watch as well. But my guess would be, once again, to go back, I guess, to the question is no, I don't think that the shock waves in general around the economy are done. We'll see if it's the US banking sector or pops up somewhere else, but I think we'll still see these knock-on impacts of higher and higher interest rates. So Lisa's saying BBSW linked hybrid securities have benefited investors during inflation. Yeah, so the good thing about hybrids is generally hybrids are floating rate. So as we see inflation and higher interest rates, you are getting an increase in that interest payment you're getting, which you don't get out of fixed income. So bonds that have fixed interest rates, those we're just seeing falling in value, and bonds have not done well the past year and a half. So Michael said, did a quick example for you. You can hide lack of real profitability. Sales of 100, cost of sales of 80. Therefore, so we're looking at margin here. Sorry, I'm just trying to read your example. Okay, so basically what Michael's looking at is looking at how inflation impacts both the revenue side of things and the cost of goods. So I will keep your comment, actually read through it and think about it. But yeah, something I need to think about. Okay, so we've got a question from Anthony. So Aussie small caps versus AS 100 valuation, small's looking more attractive. Yeah, so what I will say is globally, and in Australia as well, we have seen large cap, bigger companies outperform small caps. And a lot of people are saying that Australian small caps are actually looking more attractive. So I'm doing an interview on Thursday with a small cap manager around our conference. If anyone wants to come to our conference, tickets are available now. But small caps have underperformed for a while now. So a lot of people are saying that that's an attractive part of the market. Now, in theory, what we're told over the long term is that small companies, there's more risk involved. And you can think about it just from business risk perspective, that if I'm a new company that's just emerging, I may make it, I may not. There's a lot of elements around small companies that naturally make them a little riskier. But for those small companies that do make it and turn into the next Google, then of course investors can make a lot of money. So generally what you see is you see higher returns over the long term from small caps and more volatility. You see them bouncing around more in value. So if you're well diversified, a couple companies go out of business, that's okay. A couple companies make it. They really make it. It's dragging those returns up. But that has not happened recently. So we have seen large caps continue to outperform. So a lot of people are saying the small caps are attractive. Let's see what else we have here. Lisa says, where should I go for conference tickets? Well, you can go for conference tickets. You can email me. So if anyone wants information on conference tickets, email me. So our conference is in October. We're doing a digital day. So that's what this interview I'm doing the other day, doing a digital day. Then we're doing an in-person day in Sydney, which is also streamed for people that want to watch from the comfort of their home. We're doing it at the International Conference Center here in Sydney, if anyone's interested in conference tickets. All right. So I think I'm going to leave that there, but send me an email. I can send you a link for the conference tickets. I think it's a pretty good deal. I think it's $27.50, which isn't much, and that's actually gone down. So from an inflation standpoint, conference tickets could go down. My email address is mark.lamonica1@morningstar.com, and you can bring a friend for 50% off, which is exciting. Anyway, hope everyone enjoyed this. We'll keep going with this earnings season theme next week, and we'll talk specific companies and opportunities and sort of what we've seen so far. So hope everyone has a great day.
This video has been prepared for clients of Morningstar Australasia Proprietary Limited and/or New Zealand wholesale clients of Morningstar Research Limited. Any general advice has been provided without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.